Something absolutely massive just happened in the silver market. And if you're not paying attention right now, you could miss one of the biggest financial moves of this decade. Smart money, the institutions, the whales, the players who know something we don't, just pulled $2.8 billion out of silver. That's billion with a B. And here's the thing that should terrify you. They didn't do it slowly. They didn't ease out. They yanked it out fast, like someone pulling their hand away from a hot stove. So the question isn't whether something big is coming. The question is, are you ready for what happens next? Because what I'm about to show you in this video will completely change how you see the silver market, the economy, and maybe even your entire investment strategy. Stay with me, because by the end of this, you'll understand exactly why the smartest investors on the planet are running for the exits right now. Welcome back to The Silent Collapse, where we cut through the noise and show you what's really happening behind the curtains of global finance. I'm not here to sell you hopium or tell you everything's going to be fine. I'm here to show you the raw data, the real movements, and the truth that mainstream media won't touch with a 10-foot pole. And today, we're diving deep into one of the most concerning developments I've seen in months. $2.8 billion pulled from silver. Let that sink in for a moment. That's not retail investors getting nervous and selling a few coins. That's institutional money, the kind of money that moves markets, making a calculated exit, and they know something. Before we go any further, let me ask you something. When was the last time you saw smart money make a massive move like this and it turned out to be nothing? I'll wait. The reality is, these institutions employ armies of analysts, economists, and researchers who spend every waking hour studying market trends, geopolitical risks, and economic indicators that most people don't even know exist. When they move, especially when they move this much money this quickly, it's not random, it's not emotional, it's strategic. And right now, their strategy is screaming one word: exit. Now, I know what some of you are thinking. Maybe this is just a normal correction. Maybe it's profit-taking. Maybe silver was overvalued and they're just rebalancing their portfolios. And look, I get it. I really do. In normal times, that explanation might hold water. But these aren't normal times. We're living through one of the most unstable economic periods in modern history. Inflation is ravaging purchasing power. Central banks are flip-flopping between raising rates and cutting them. The banking sector just went through a crisis that saw multiple institutions collapse in a matter of days. And geopolitical tensions are at levels we haven't seen since the Cold War. So no, this isn't just a normal correction. This is something much bigger. Let me paint you a picture of what's been happening in the silver market over the past few years. Silver has always been the volatile cousin of gold. Where gold is steady, reliable, the safe haven that everyone runs to during crisis, silver is wild. It swings harder, moves faster, and attracts a different kind of investor. You've got industrial users who need it for solar panels, electronics, and electric vehicles. You've got stackers, the people who buy physical silver and hold it as a hedge against inflation and currency collapse. And then you've got the speculators, the traders who chase momentum and try to ride the waves for profit. All these groups create a market that's incredibly sensitive to economic shifts. And right now, that market is sending us a signal that we cannot ignore. Here's where it gets really interesting. When we look at the timing of this $2.8 billion exodus, it coincides with some very specific economic events. First, the Federal Reserve recently made statements about keeping interest rates higher for longer than previously expected. Now, why does this matter for silver? Because silver, unlike stocks that pay dividends or bonds that pay interest, doesn't generate yield. When interest rates are low, holding silver makes sense because you're not missing out on much return elsewhere. But when rates go up, suddenly that silver sitting in your vault or your portfolio isn't looking as attractive. You could be earning 5% or more in a money market fund or treasury bonds with zero risk. So smart money starts asking themselves, why am I holding an asset that doesn't pay me anything when I could be earning guaranteed returns elsewhere? But that's just one piece of the puzzle. The second factor, and this is huge, is the strengthening US dollar. Silver, like most commodities, is priced in dollars. When the dollar gets stronger, commodities get more expensive for foreign buyers, which reduces demand. And we've seen the dollar index climbing steadily over the past several months, making silver less attractive to international investors and industrial users. If you're a manufacturer in China or Europe and silver just got 10% more expensive because of currency fluctuations, you're going to think twice about your purchasing decisions. You might delay orders, look for alternatives, or try to negotiate better prices. All of that translates into reduced demand, which puts downward pressure on prices. And smart money sees this coming from miles away. Now, let's talk about the industrial demand side, because this is where things get even more concerning. Silver has always had this dual nature. It's both a precious metal and an industrial commodity. About half of all silver demand comes from industrial applications. Solar panels, electronics, medical equipment, batteries, the list goes on. And here's the problem. Global economic growth is slowing down, The manufacturing sector in China, which is the world's factory, has been showing signs of weakness. Europe is teetering on the edge of recession. Even in the United States, manufacturing data has been mixed at best. When industrial production slows down, demand for silver falls. And when demand falls while supply remains steady or even increases, prices drop. It's basic economics, and the smart money isn't waiting around to see how bad it gets. But wait, there's more. And if you're enjoying this deep dive into what's really happening in the markets, do me a favor right now. Hit that like button and subscribe to The Silent Collapse. We are one of the few channels that brings you this level of analysis without the mainstream media filter. And your support helps us keep digging into these stories that matter to your financial future. Seriously, it takes 2 seconds, and it makes a massive difference. Okay, back to the silver situation. One of the aspects that doesn't get talked about enough is the paper silver market versus the physical silver market. You see, most silver trading doesn't actually involve physical metal changing hands. It's all done through futures contracts, ETFs, and other financial instruments that represent claims on silver. The problem is, there's way more paper silver being traded than there is actual physical silver in existence. Some estimates suggest that for every ounce of physical silver, there are up to 100 ounces of paper silver being traded. Think about that for a second. It's like 100 people all holding tickets to the same seat on an airplane. As long as everyone doesn't show up at once, the system works. But the moment people start demanding physical delivery, the whole thing could collapse. And here's where the $2.8 billion withdrawal becomes even more significant. When institutional investors pull out of silver ETFs and futures contracts, they're essentially reducing their exposure to paper silver. But some of them, the really smart ones, might be quietly accumulating physical silver instead. Why would they do this? Because they understand that in a real crisis, paper promises don't mean anything. If the financial system experiences severe stress, if banks start failing, if currency loses value rapidly, the only thing that will matter is what you can hold in your hand. Physical gold, physical silver, real assets, not digital entries in a database that could disappear with a click of a mouse. There's also the question of market manipulation, and I know this gets into controversial territory, but we have to address it. The silver market has been investigated multiple times for price manipulation. Major banks have been fined hundreds of millions of dollars for spoofing and manipulating precious metals markets. This isn't conspiracy theory. This is documented fact. These institutions have the power to move markets with their trading activity, and they've proven time and time again that they're willing to use that power for profit, even if it means breaking the rules. So when we see a massive outflow like $2.8 billion, we have to ask ourselves, is this part of a larger manipulation strategy? Are they driving the price down so they can accumulate at lower levels? Or are they genuinely exiting because they see a storm coming? Let's zoom out for a minute and look at the bigger economic picture, because silver doesn't exist in a vacuum. What happens in the broader economy directly impacts precious metals markets. Right now, we're seeing a confluence of factors that historically have led to major market disruptions. Government debt levels are at all-time highs across developed nations. The United States alone has over $33 trillion in national debt, and that number is growing by trillions every year. Europe is drowning in debt. Japan's debt to GDP ratio is over 250%. These aren't sustainable numbers, and everyone knows it, but nobody wants to be the one to address it because the solutions are politically toxic. At the same time, we're seeing de-dollarization accelerate around the world. Countries like China, Russia, Brazil, and India are increasingly conducting trade in their own currencies instead of US dollars. They're building alternative payment systems to reduce their dependence on Western financial infrastructure. And they're buying gold, lots of gold, to back their currencies and protect themselves against dollar volatility. Now, you might ask, what does this have to do with silver? Everything. Because as faith in fiat currencies erodes, precious metals become more valuable. But here's the twist. In the short term, during the transition period, markets can be incredibly volatile. Smart money knows this. They know that before precious metals soar, there might be a period of intense price suppression, market manipulation, and volatility designed to shake out weak hands. So they exit their positions, wait for the storm, and then come back in at much lower prices. The banking crisis earlier this year should have been a wake-up call for everyone. We saw Silicon Valley Bank, Signature Bank, and First Republic Bank all collapse in rapid succession. Credit Suisse, a bank that had survived for over 150 years, was forced into a shotgun merger with UBS. And the only reason we didn't see a complete meltdown of the financial system was because central banks and governments stepped in with emergency measures, guaranteeing deposits and providing unlimited liquidity. But here's the thing. Those problems didn't go away. They were just papered over. The underlying issues, the bad loans, the risky investments, the over-leveraged balance sheets, they're all still there. And smart money knows that the next crisis could be even worse. From a technical analysis perspective, silver has been showing some very concerning patterns. If you look at the charts, and I know not everyone is into technical analysis, but bear with me, silver has been forming what's called a head and shoulders pattern. For those who don't know, this is one of the most reliable reversal patterns in technical analysis. It suggests that an uptrend is ending and a downtrend is beginning. The fact that institutional money is flowing out right as this pattern is completing is not a coincidence. These traders have algorithms and systems that identify these patterns and execute trades automatically. They're not emotional. They don't hope for the best. They see a sell signal and they sell. Additionally, we're seeing divergence in the momentum indicators, the relative strength index, the MACD, the stochastic oscillator, all of these technical tools that traders use to gauge market strength, they're all showing weakness. Volume has been declining on up moves and increasing on down moves, which is a classic sign of distribution. That's when smart money is selling to less informed investors who think they're getting a good deal. It's the oldest game in the market, and it happens every single cycle. The question is, are you going to be the one holding the bag when the music stops? Or are you going to pay attention to what the data is telling you? We also can't ignore the geopolitical situation, because it's directly impacting precious metals markets. The conflict in Ukraine continues with no end in sight. Tensions between the United States and China over Taiwan are escalating. The Middle East is a powder keg that could explode at any moment. Normally, these kinds of geopolitical risks would send investors rushing into precious metals as a safe haven. But here's what's interesting. Despite all this chaos, we're not seeing that flight to safety in silver. Gold has held up relatively better, but silver is underperforming. Why? Because smart money is differentiating between the two metals. They're recognizing that gold is the pure safe haven play, while silver's industrial demand makes it more vulnerable to economic slowdown. In a global recession, which many analysts believe is coming, industrial demand for silver collapses, which puts downward pressure on prices regardless of its safe haven characteristics. Now, I want to be fair here and present some contrarian viewpoints, because not everyone agrees that this outflow is a bearish signal. Some analysts argue that this is actually a bullish setup. Their logic goes like this. When everyone is bearish and selling, that's when you should be buying. Markets are driven by sentiment as much as fundamentals, and when sentiment reaches extreme levels of pessimism, it often marks a bottom. They point to historical examples where massive outflows from precious metals were followed by explosive rallies. The dot-com crash in 2000, the financial crisis in 2008, there are precedents for this kind of behavior. These bulls also argue that the fundamentals for silver remain strong long-term. The transition to green energy requires massive amounts of silver for solar panels. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure build-out needs silver. The supply side has its own challenges, with many silver mines struggling with declining ore grades and rising production costs. So the argument is that even if we see short-term pain, the long-term trajectory for silver is up. And maybe, just maybe, this $2.8 billion outflow is just smart money taking profits before the next leg up. I respect that viewpoint, and I think it's important to consider all possibilities. But here's my pushback. Timing matters. Yes, silver might be higher 10 years from now, but if you buy today and it drops 30 or 40% over the next year, that is a significant loss of capital that could have been deployed elsewhere or used to buy silver at much lower prices. The opportunity cost of being early is real, and it can be painful. Smart money isn't just concerned with being right eventually. They want to maximize returns and minimize risk right now. And right now, the risk-reward ratio in silver doesn't look favorable to them. Here's something that really bothers me, and I think it's important to address. There's a huge segment of the retail investor community that has been sold on the idea of the silver squeeze, the notion that if enough small investors buy physical silver, they can force a short squeeze and send prices to the moon. And look, I understand the appeal. It's the David versus Goliath story. The little guy standing up to the big banks and winning. But the reality is far more complicated. The silver market is enormous, worth hundreds of billions of dollars. The amount of buying power that retail investors can muster, while significant, is not enough to overcome the institutional selling pressure we're seeing right now. When $2.8 billion flows out in a short period, that overwhelms retail buying. And here's the really insidious part. While retail investors are being encouraged to buy and hold, smart money is exiting. This creates a transfer of wealth from unsophisticated investors to sophisticated ones. The retail crowd buys at high prices driven by emotion and hype, while institutions sell to them and then wait for prices to drop before buying back in at lower levels. It's a tale as old as markets themselves, and it's happening right now in silver. I'm not saying this to discourage anyone from investing in silver. I'm saying it because I want you to be informed and make decisions based on data and strategy, not emotion and hope. Second, consider diversification. One of the biggest mistakes investors make is concentrating too much of their wealth in a single asset class. Yes, precious metals should probably be part of a well-diversified portfolio, but they shouldn't be the whole portfolio. You need exposure to different asset classes that perform well in different economic environments. Stocks, bonds, real estate, commodities, cash, each has its place. The key is finding the right balance based on your individual circumstances, risk tolerance, and financial goals. If we look back at history, we can find some interesting parallels to our current situation. In the early 1980s, silver experienced a massive spike, followed by a brutal crash. The Hunt brothers tried to corner the silver market, driving prices to all-time highs before regulators stepped in and changed the rules, causing prices to collapse. Fortunes were made and lost in a matter of months. The lesson there is that silver can be incredibly volatile, and forces beyond supply and demand, including regulatory intervention and market manipulation, can dramatically impact prices. More recently, in 2011, silver rallied from around $17 an ounce to nearly $50 in a matter of months, driven by fears of currency debasement and inflation following the financial crisis. But then it crashed back down, losing more than half its value within a year. Investors who bought near the top suffered devastating losses, while those who waited and bought during the subsequent decline made substantial profits. The pattern repeats over and over. Hype drives prices up beyond what fundamentals justify. Smart money exits. Retail investors hold on hoping for a recovery, and prices eventually find a bottom before the next cycle begins. Now, here's where things get really interesting for contrarian investors. If this outflow represents capitulation and maximum pessimism, it could actually be setting up one of the best buying opportunities we've seen in years. The key is patience. You don't want to catch a falling knife. You want to wait for signs that the selling has exhausted itself and a bottom is forming. What would those signs look like? Decreasing outflows or even inflows returning? Price stabilization and consolidation after a decline, positive divergences in technical indicators, improving sentiment among professional traders. These are the signals that suggest a turn might be coming. Third, stay informed. And I don't mean watching mainstream financial news that's designed to keep you confused in trading. I mean doing real research, understanding market dynamics, following the smart money flows, and thinking critically about what you're being told. That's exactly why channels like The Silent Collapse exist. We're here to cut through the nonsense and show you what's really happening. And if you haven't already, make sure you're subscribed because we're going to be covering these developments as they unfold. This story is far from over. The withdrawal of $2.8 billion from silver also tells us something about broader economic expectations. Smart money is positioning for a specific scenario, and we can infer what that scenario might be by looking at where they're moving their capital. Recent data shows increased flows into short-term treasury bills, money market funds, and defensive stocks. This is classic risk-off positioning. It suggests that institutions are expecting volatility, potential market downturns, and economic uncertainty. They're prioritizing capital preservation over growth. They want liquidity and safety, not speculation and risk. This defensive positioning makes sense when you consider the macroeconomic headwinds we're facing. Consumer spending is slowing as excess pandemic savings are depleted and credit card debt reaches record levels. The labor market is showing signs of softening, with job openings declining and layoffs increasing in certain sectors. Corporate earnings are under pressure from higher input costs and weakening demand. Commercial real estate is in crisis, with office buildings sitting empty and property values plummeting. And the Federal Reserve is maintaining restrictive monetary policy, which historically has led to recessions. All of these factors create an environment where risk assets, including speculative positions in silver, become less attractive. Some of the best investments are made when everyone else is fearful and selling. Warren Buffett's famous advice to be greedy when others are fearful applies here. But the devil is in the details. Being greedy doesn't mean being reckless. It means doing your homework, having a clear strategy, and executing with discipline when the opportunity presents itself. If silver does experience a significant decline from here and smart money's exit suggests it might, that could create an incredible entry point for long-term investors who believe in the metal as fundamental value proposition. And speaking of different perspectives and strategies, I want to hear from you. Drop a comment below and let me know what you think about this massive outflow from silver. Are you concerned? Do you see it as a buying opportunity? Are you holding, selling, or waiting on the sidelines? The community we are building here at The Silent Collapse is all about having real conversations about these issues, and your insights and experiences add tremendous value. Also, if you found this analysis helpful, share this video with friends and family who might benefit from understanding what is happening in the precious metals markets. The more people who are informed and prepared, the better we all are. Let's explore some alternative scenarios, because the future is uncertain and we need to think about different possibilities. Scenario 1, the bearish case. Smart money is right. Economic conditions deteriorate significantly, industrial demand for silver collapses, and prices fall substantially from current levels. In this scenario, investors who exited or reduced positions preserve capital and can re-enter at much more attractive prices. Those who held on suffer paper losses and opportunity costs. Scenario 2, the sideways case. Prices remain range-bound for an extended period as bulls and bears fight it out. Neither side wins decisively, and silver just grinds sideways, frustrating everyone. In this scenario, capital is tied up with no meaningful return, and investors would have been better off in yield-bearing assets. Scenario 3, the bullish surprise. Despite the outflows, something unexpected happens. Maybe a major geopolitical event, a currency crisis, or supply disruption sends silver prices sharply higher. In this case, those who held positions or bought during the weakness are rewarded. But here's the key question. What's the probability of each scenario? Based on current data, smart money positioning, and macroeconomic conditions, I'd argue the bearish or sideways scenarios are more probable than the bullish surprise. That doesn't mean the bullish case can't happen. It just means you need to weight probabilities when making investment decisions. Central bank policy is absolutely critical to understanding precious metals markets, and we need to talk about what the Federal Reserve and other central banks are doing. The Fed has made it clear that fighting inflation is their top priority, even if it means accepting slower economic growth or a mild recession. They've raised interest rates at the fastest pace in decades, and they're maintaining those higher rates despite growing pressure to cut. This matters for silver because higher interest rates increase the opportunity cost of holding non-yielding assets. Why hold silver that pays you nothing when you can get 5% risk-free in treasury bills? But there's another layer to this. Central banks around the world have been buying gold at record rates, but they're not buying silver. That tells you something about how the world's most sophisticated economic institutions view these metals differently. Gold is seen as a monetary asset, a reserve currency, something that holds value regardless of economic conditions. Silver, despite its precious metal status, is viewed more as an industrial commodity with safe haven characteristics. The divergence in central bank behavior reinforces the point that smart money sees these metals serving different purposes. Let's dig into the actual supply and demand fundamentals, because this is where the rubber meets the road. On the supply side, global silver mine production has been relatively flat for the past decade. There haven't been major new discoveries, and existing mines are dealing with declining ore grades, meaning they have to process more rock to get the same amount of silver. Production costs have risen due to higher energy prices, labor costs, and regulatory requirements. This suggests that supply is somewhat constrained, which should be bullish for prices, all else being equal. But all else is not equal. On the demand side, we have to separate industrial demand from investment demand. Industrial demand, as I mentioned earlier, is heavily tied to global economic activity. If we enter a recession, manufacturers will cut production, which means they'll need less silver. Investment demand is where things get really interesting. This includes purchases of silver coins, bars, and ETFs by individuals and institutions. And, as we've seen with the $2.8 billion outflow, investment demand is declining right now. When investment demand falls, it can more than offset any supply constraints, leading to lower prices. Understanding market psychology is crucial to navigating these situations successfully. Markets move in cycles driven by human emotion. Fear and greed, euphoria and panic, these emotional extremes drive prices far beyond what fundamentals alone would justify. In precious metals markets, we see this play out repeatedly. During times of economic uncertainty, fear drives investors into gold and silver, pushing prices higher. As prices rise, greed takes over, attracting speculators and momentum traders who pile in, driving prices even higher. Eventually, prices reach unsustainable levels, smart money starts exiting, and the cycle reverses. Fear returns, but now it's fear of losses, causing selling pressure that feeds on itself. Right now, we appear to be in the phase where smart money is exiting and sentiment is shifting from greed to fear. The $2.8 billion outflow is a manifestation of this shift. Retail investors who got excited about silver during the rally are now facing losses and questioning their decisions. Some will panic sell at the worst possible time. Others will hold on stubbornly, refusing to accept reality. The smart ones will step back, reassess the situation objectively, and make rational decisions based on data rather than emotion. Which category do you fall into? As we bring this deep dive to a close, let me synthesize everything we've covered into some actionable insights. The $2.8 billion withdrawal from silver is significant and should not be ignored. It represents smart money reducing risk exposure in an asset that faces multiple headwinds, including rising interest rates, a strengthening dollar, weakening industrial demand, and challenging macroeconomic conditions. This doesn't necessarily mean silver is going to zero or that it's a terrible investment. It means that in the current environment, the risk-reward profile has shifted unfavorably. For current holders, this is a time to reassess your position. If you bought silver as a long-term hedge against currency debasement and systemic risk, and you're comfortable with volatility, then short-term price movements shouldn't change your thesis. But if you're sitting on losses and hoping for a recovery, you need to be honest with yourself about whether the hope is based on sound analysis or just wishful thinking. Sometimes the hardest but smartest decision is to cut losses and redeploy capital where the odds are more favorable. For potential buyers, patience is key. Don't try to catch falling knives. Let the selling exhaust itself. Wait for signs of stabilization and reversal. Use technical analysis and sentiment indicators to identify potential entry points. And when you do buy, have a clear plan with defined risk parameters. Know where you'll add to positions if you're right, and know where you'll exit if you're wrong. Discipline separates successful investors from everyone else. The financial markets are constantly evolving, presenting both opportunities and risks. The smart money withdrawal from silver is just one piece of a much larger puzzle that includes monetary policy, geopolitical tensions, technological change, and shifting economic paradigms. Staying informed, thinking critically, and maintaining emotional discipline are essential for navigating these waters successfully. This is exactly what we do here at The Silent Collapse. We dig deep, we ask tough questions, and we share insights that you won't find in mainstream financial media. If this analysis has been valuable to you, I want to ask you one more time to hit that like button and subscribe to the channel. And don't just subscribe. Turn on notifications so you don't miss our upcoming videos where we'll continue to track these developments and explore other critical financial topics. Share this video with anyone you know who's interested in precious metals, investing, or understanding what's really happening in the economy. Knowledge is power, but only if you act on it. The withdrawal of $2.8 billion from silver is a warning shot across the bow. Smart money is telling us something, and we'd be wise to listen. Whether this leads to a major decline, a period of consolidation, or sets up an incredible buying opportunity remains to be seen. But one thing is certain. Those who pay attention, who do their research, and who position themselves intelligently will be the ones who profit when the dust settles. Don't be caught off guard. Don't be the one left holding the bag. Be smart, be strategic, and stay informed. This is The Silent Collapse, and I'll see you in the next video where we continue to uncover the truth about what's happening in the world of finance.